In the early 1980s, making money in the markets meant screaming over the chaos of a crowded trading pit. This environment sparked a famous debate between two legendary commodity traders, Richard Dennis and William Eckhart. Eckhart believed successful traders were born with an innate intuition for the market. Dennis argued that intuition was a myth and that anyone could be taught to trade. To understand why Dennis was right, we have to look at why most modern retail forex traders fail. When faced with a moving market, beginners rely on a combination of emotion, guesswork, and messy chart setups to predict where the price will go next. Dennis designed an experiment to strip that human emotion entirely out of the equation. He recruited a group of absolute novices, dubbed them the Turtles, and forced them to execute a strictly mechanical, rigid trading system. No gut feelings allowed. Over the next few years, this group of novices generated an average annual compound return of over 80%. By the end of the experiment, these individuals with no prior experience had outperformed veteran traders simply by adhering to a mathematical curriculum. It suggested that a rigorous enough system could effectively replace human intuition. We're going to break down those instructions now, starting with how the Turtles identified market moves. Module 1 of the Turtle curriculum replaces emotional predictions with a purely objective entry sensor known as the Donchian Channel. Looking at this chart, you'll see the Donchian Channel mapping out recent price history using 3 distinct bands. The upper band is the absolute highest price over a set period, usually 20 days. The lower band marks the 20-day low. The middle band represents the exact average between the two. The long entry rule is a simple if-then statement. A trader only executes a buy order if the market price pushes up and pierces the upper 20-day band. But there is a crucial filter. An intraday spike above the channel could easily reverse, leaving behind a long wick and a failed breakout. The Turtles required the daily candlestick to fully close outside the channel to prove the buyers had actual conviction. The short entry follows the exact logic in reverse. You sell only when the daily price breaks through and strictly closes below the lower 20-day band. Waiting for that daily close turns the entire process into a binary logic gate. The price either closed outside the channel or it didn't. The hesitation is gone. While the Donchian breakout provided the signal, the mechanical management of risk provided the profit. The Turtles used a specific mathematical framework to ensure no single trade could threaten their capital. To manage risk properly, you have to measure the market's current volatility. This gauge displays the average true range, or ATR. It calculates the average height of recent price swings, letting you know exactly how much breathing room a trade needs so you aren't knocked out by normal market noise. The Turtles tied this ATR data to a non-negotiable rule. Maximum exposure is capped at 1% of the total account balance per trade. If you trade with a $20,000 account, your absolute maximum allowable loss on any single position is $200. With the dollar risk set, you place your initial stop-loss order exactly 2 times the ATR distance away from your entry price. Finally, to determine the size of your actual trade, you take that fixed $200 risk limit and divide it by the total distance to your stop-loss. By dividing the dollar risk by the ATR distance, your financial loss is completely standardized. If a currency pair is quiet, you take a larger position. If the pair is swinging wildly, the math automatically shrinks your position down. Either way, hitting your stop-loss always results in a 1% hit. Standardizing risk through ATR shields the trader against market unpredictability. No single bad trade can wipe out the account. Once you enter a position safely, you need a mechanical system to get out. You have to lock in profits without choking off a major months-long trend. Looking at this updated layout, you'll see how the Turtles manage this. They overlaid a tighter 10-period channel inside the original 20-period one. During a profitable upward trend, they let the market run until the price dipped back down and closed below this faster 10-period line, signaling an actual reversal. A modern alternative for 24-hour forex markets is an ATR trailing stop. This mechanism ratchets your stop-loss upward as profits increase, but mathematically refuses to move downward. Exits require the exact same algorithmic objectivity as your entries. Manually guessing when a trend is over guarantees you will leave money on the table. Every system has an Achilles heel. For this strategy, it's the whipsaw effect of sideways markets. Watch what happens when a market moves horizontally. The price will repeatedly poke its head out of the channel, triggering false breakout signals. It forces the trader to enter a position, only to instantly reverse and stop them out. This reveals the harsh psychological reality of the turtle system, operating on a low overall win rate. You have to endure long drawdowns and strings of back-to-back losses. The turtles generated returns not because they won often, but because their strict 1% risk limits preserved capital through dozens of tiny cuts. But when the market eventually broke into a massive trend, they were perfectly positioned to ride it out. Your edge in Forex is not a magical indicator. Your edge is having unwavering discipline to follow the rules while trapped in a losing streak. Log into the FXNX platform, load a 20-period Donchian channel, and practice.